Hi. In case you don't know me, my name is Phil Telpner. I am the owner and lead advisor at my firm, Breakout Private Wealth. The purpose of this midweek video today uh, is to help people think in terms of segmenting their wealth. Now, I know tonight on the news, everybody's going to be talking about the Fed and the quarter point raise, and are they done? Are they going to ease? What's going to happen with the banks and all that stuff that is out of our control? When we work with clients, we help them with things that we can control. Very important distinction, and we come back to it often. On my website, breakoutprivatewealth.com, there's a great graphic that we put together highlighting exactly how we help our clients think about their wealth. We call it tranches, but basically we segment somebody's wealth into different strategies that are aligned with when they may need the money. Let me give you a great example. I have a client who, well, I use myself as an example. I have one son in college, one soon to be son in college. We're fortunate enough to have some assets in 529 accounts for them. And since we are using those assets and intend to for the next few years, we are not subjecting those assets to market risk. There is no guarantee that in the next 2 to 4 years that markets will perform when we need them to. And quite honestly, even if they did, it wouldn't be enough to minimize the risk or the regret of experiencing just a normal pullback. I see that all the time with people that are misaligned their investments with their time frame. Very, very, very important. If you're, let's say, a younger family, maybe 40 years old, and you're or 35, and you're thinking about buying a home in the next few years, well, those assets that you have earmarked for that down payment or construction, what have you, do not belong in the market. A lot of people, most people I find, don't quite think it through in that way. Something else to think about here. This doesn't necessarily apply to everybody, but certainly as you move further down in age where it might, is what we call this tranche 2 years 4 to 10. So again, while those assets need to be invested, they most likely, and this is situation dependent, but they most likely should not be exposed to the full volatile nature of the equity markets, the stock markets, if you will. Something else to think about there. There's different strategies that we would use there to still generate returns, because that's long enough to be able to generate returns, but to minimize the volatility of those returns. And then we have our long-term bucket, which is what, or tranche, which is what people historically think of as investing. And that's fine. But to be honest, unless these first two tranches are discussed and are set up correctly, there is almost no chance of the long-term investing working, because invariably for all of us, life gets in the way. So Thought that helped. Focus on the things you can't control. Have a great week.